how I discovered the 3 unshakable rules of investing and how you can use them. Thai Puri. My early investing mistakes and what they taught me. I started investing at 11, but I wasted years chasing fun strategies. Stock timing, chart patterns, and technical tricks were exciting, but profitless. By 19, I devoured every investing book in the library, yet I had no real framework. Then in 1949, I read The Intelligent Investor by Benjamin Graham. 2 chapters changed everything. They gave me a philosophy so simple, yet so powerful, that it became the foundation of my success. Here are the Q3 timeless principles, guys, that transformed my investing and how you can apply them today. 1. Today's stock is a business, not just a ticker symbol. Most investors treat stocks like lottery tickets. Graham taught me, a stock is ownership in a real business. Value the business, not the ticker. Ask, what does this company do? Who are its competitors? Is management competent? Example, I memorized every NYSE ticker symbol at 12, but knew nothing about the actual businesses. Big mistake. Key takeaway, stop staring at charts, start analyzing companies. 2. Mr. Market is your manic depressive partner. Graham's genius analogy, the stock market is Mr. Market, an emotionally unstable partner who offers to buy, sell your business daily. Some days he's euphoric, prices soar. Other days he's depressed, prices crash. Your job? Ignore his mood swings. Only transact when it benefits you. Example, farmland values barely fluctuate, but stocks of great companies swing wildly, creating opportunities for disciplined investors. Key takeaway, the market's job isn't to guide you, it's to serve you. 3. The margin of safety, your investing seatbelt. Would you drive a 9,800-pound truck over a 10,000-pound bridge? No. So why invest without a safety net? Graham's rule, I always buy at a discount to intrinsic value. This margin of safety protects you from errors or bad luck. Example, if you value a business at $100 share, buy at 70, not 110. When I take away, investing isn't about precision, it's about protection. Just how to find unbreakable businesses, my Tennessee test. So imagine you have 1 week and must to invest $1 in 3 Tennessee businesses forever. How would you choose? Look for a moat. Does the business have enduring advantages? Brands, patents, scale. Example, Coca-Cola's moat is its global brand loyalty. RC Cola can't compete no matter how much it spends. Trustworthy management. Are leaders able and honest? Bonus, buy businesses so strong that even a dope could run them. Sensible price, even great businesses fail if overpaid for. Key takeaway, if you wouldn't buy the whole company, don't buy a single share. Durtars, final rule, patience beats activity. You don't need 100 ideas to get rich. You need 5 great ones in a lifetime. Treat each investment like a punch card with 20 slots. Every punch must count. At Berkshire, we ignore small opportunities. We wait for the rare moments when everything aligns. Great business, fair price, and a margin of safety. That's how you win.